I like oil, I like energy, I like the whole complex. I'm very worried about the entire complex right now. Because what's happening currently is something that we have not seen since the early 80s. We are going to have, in the next course of the next 12 months, roughly about 30% of existing oil and energy businesses will no longer exist. There's going to be a wave of bankruptcies. A lot of hedges are going to roll off starting in May and June of this year, a little bit later. The value of lower oil prices is going to continue to impact oil operating revenues, and which leads to CapEx. And this is one of the interesting things. You'll hear people come out and say, well, you know, if you strip out energy earnings, the earnings for the S&P 500 don't look that bad. Well, the problem is that when we were blowing earnings out the roof because energy companies were a huge contributor to earnings, we didn't say, well, if you X out energy earnings, the S&P really doesn't look that good. So you can't really have your cake and eat it too. You got to take it as it comes. But here's the important thing about energy. Energy creates some of the highest wage-paying jobs. And the energy sector alone makes up almost 25% of the entire capital expenditures of the entire economy. Why? Because when you go drill a well, it's very cost intensive versus sticking up a computer and putting a guy behind it and say, go tweet. So the issue with energy as it relates to the entire economy is extremely important. It's jobs, it's capital expenditures, it's production increases, and it also relates to all those other jobs. How many buildings have been built for energy companies? How many jobs have been created to support the energy industry, whether it's pipes or whether it's fittings or trucking or cement or water hauling, you name it. And then all those people, they need to have houses, they need to eat somewhere, and if they didn't have the energy industry as their income, you see the problem? Energy, since it's the infrastructure of our entire economy, is extremely important. I know, and I'm telling people who live in Houston this, I know you already know this. But the question is, well, oil's bottomed. Maybe. We may have seen a bottom in oil prices. There's a real possibility, though, that we may not see a return to $100 barrel oil, $80 barrel oil, $70 barrel oil anytime soon. Because what we have here is the supply of oil relative to global demand. Now, global demand has picked up here over the last couple of weeks, and we've seen a little bit of pickup here slightly because of kind of what's happening on the imbalances of economies. But global demand is weaker than it was back in 2009 when the fracking miracle took over. And the explosion in the amount of supply now equates us back to where we were in the early 80s. So from a supply-demand basis alone, one of my concerns is that we may be trapped at lower price levels in oil for quite some time as we work off the supply issue. And this is oil as it relates to the supply of oil versus the price of West Texas Intermediate crude. As you'll notice, it didn't mean that we didn't have big rallies in oil prices. We did. During the 80s and 90s, you had very big rallies in the prices of oil. The problem is it just wasn't sustainable because overall supplies had to be worked off. And you can't just go shut in a massive amount of supply overnight because companies still have to operate. Now, if you're willing to bankrupt the entire energy sector to get supplies back to, well, where they need to be, we can do that, but I don't think that people really like that economically. Although President Obama might like it because he doesn't really like the energy sector anyway. He's got the coal industry on its back as we speak. But my concern is that right now there's a lot of people talking about, well, look, we have this huge rally in oil prices. That's surely the bottom. Be careful with that. Because first of all, if you look at the recent rally as compared to where we were, you can barely notice it. Nothing goes straight down. Although it looks like it goes straight down. But nothing goes straight down. Everything's going to bounce because you get the rubber band stretched too far in one direction. These bounces are fantastic trading opportunities. We can trade opportunities within the energy sector. But you want to be real careful about energy companies that you may own because there's a lot that are potentially facing problems. Whiting Oil up in North Dakota is doing a massive equity issuance, trying to stay alive at this point. We're seeing a bunch of, and there's a rumor that a lot of the recent rally in oil has been driven by banks to allow companies that are on the verge of bankruptcy to do an equity issuance to pay off the debt at the bank so they can get the banks out of the picture. And this has been orchestrated between the Federal Reserve and the banks and the markets. Rumor, speculation. I'm not confirming or denying such, I'm just saying. Here's the other issue that concerns me. This is oil supply again. This is rig count. The problem is that we now have the lowest rig count that we've had ever. And we're not really affecting the supply of oil that much. But Lance is coming, maybe. I'm not saying that's not the case. But you have right now Iran exporting oil. You've got OPEC still exporting oil. Everybody's hoping for an oil supply, an oil production freeze. I'm not sure that does any real help, just to freeze it. But the other problem is that the benefit of fracking, because you were all calling me, telling me about the technological advances of fracking and how we can frack so much more efficiently and so much cheaper, and we can extract so much more now than we were ever able to before because of the increases in technology, works great on the way up, and it's a bad thing on the way down. Because we're still able to extract more efficiently. We're still able to produce supply more efficiently, and that's the problem potentially. Again, potentially, possibly, suggesting, not stating, one of the supply issues. This is also another problem. This was from, if one of my favorite bond fund managers is Jeffrey Gundlach from Double Line. He's killed it. Man's a genius. He pointed out a very good thing the other day in his presentation. This is the Federal Reserve balance sheet versus oil production. Now, the correlation should not surprise you, but the correlation has ramifications to the future. What happened, go back to the Federal Reserve. Why did the Federal Reserve do QE? Because that liquefied the markets. Where did the money go? The money went to the major banks. What did the major banks do with it? Well, they sent the money to their proprietary trading desk and their brokerage arms, who then went to every mom and pop in the country and said, hey, you want to go frack a well? I'll give you money for it. So we had all these marginal companies go out drilling marginal wells on debt that have now led to the supply imbalance issue and has also led to the financial insecurity of the entire credit market within the financial sector. My point with this chart is with the Federal Reserve no longer liquefying the markets, there is no cushion to offset the bankruptcies that are potentially going to happen within the oil market. There's a risk that we need to be aware of. So the question is this is just a technical chart of oil prices. The banded area is what is called a standard deviation range. Prices can only move historically in a direction for so long. Again, stretching the rubber band example. 2 standard deviations. This is technical mumbo jumbo, so please forgive me for 1 second. 2 standard deviations encompass about 96% of all possible price movement. So in other words, when you get 2 standard deviations overbought or 2 standard deviations to the bottom, you've stretched the rubber band about as far as you can. And as you notice, each time when we get to the outer edges of those bands, the price moves in the other direction. So not surprisingly, just recently we got very, very oversold in oil prices, got down to $25 a barrel. Not surprising that we just had an outsized rally in oil back to 2 standard deviations above the long-term moving average. All that's saying is the green dots at the top and the bottom are the extreme overbought conditions that currently exist in oil. What that's saying is that if you're speculating in oil, you probably want to go take some profits. That's all that's saying. But it's also suggesting that this short-term rally in oil, which is within the confines of those two the diagonal lines, are well within the confines of the long-term downtrend in the price of oil. Doesn't mean that oil is going to go to $16.50 like Art Berman says. I'm not saying that. But the indication is that we have not changed the negative trend in oil prices currently. We've got a lot more work to do before we get there. So this is not yet the time to be betting all your money that we've hit the bottom in oil prices. Maybe we have. But there's no technical indication in terms of price that we have done so. Same thing goes for gold. I get a lot of people calling me up, Lance, gold's going up, we've got to buy gold, right? Okay. I like gold from the standpoint that it's an asset class. How many people own gold like physically in their house? Got a couple, everybody's like. Here's the problem with gold. I have no problem with you owning it. I think it's fine. It makes a beautiful doorstop. If you really want to have gold be effective for you as an ownership, I'm talking to all the men here, buy your wife some gold jewelry. She will give you much more dividends for that than what gold will. Goes a long way. And you still have gold, right? You still own the gold. Always cash it in later. Here's my point about gold. Gold's an asset class. Gold is extremely volatile. Gold provides no yield in terms of investing. So owning gold is fine. Here's the problem with actually owning gold itself. Eventually, someday, you're going to want to cash it in. Generally, by the time you'll want to cash it in is when everybody else is wanting to cash it in too. So you get down to the numismatic dealer to actually cash in your gold. There's a line that wraps around the building down the street 4 blocks. And the guy at the front, he's like a hawker at a circus going, yeah, I'm buying gold at $1,000, $900, $800, $700, $600. Who's buying? It's all because that's human psychology. By the time you realize you need to sell your gold, it'll be far too late. If you're worried about having gold and there's an event of an economic collapse, of course, if you listen to Stansberry Research, that's what's going to happen. We're all going to, when Donald Trump gets elected, it's all over with. And we're all going to be, fighting each other with sticks and bats. Well, if you want to own gold in the event of an economic collapse, don't own gold, own lead. Because with lead, you can get all the gold you want. Because there's some guy down the street that he hates guns, but he's got gold. I have lead. So the downtrend here in gold has not been broken. I'm not saying that you can't buy gold, but gold is extremely overbought once again. We've not broken the long-term downtrend. With the Federal Reserve, the central bank, the Bank of Japan, the Bank of China throwing the kitchen sink and everything else they can at the markets to try to stimulate some economic growth and inflate asset prices. When asset prices go up, people don't want to own gold. They want to own stocks. It's a one-to-one exchange. And the problem is that as soon as you reduce the fear of deflation and recession, people want to buy stocks. Gold has trouble going up. And that's why gold has had real struggles over the last couple of years. There will be a time to buy gold as an asset in your portfolio. And there's you use an ETF for that. You can use a mutual fund for that, however you want to do it. It's just not yet. We may be getting close to that opportunity, but we need to be breaking out of that downtrend to confirm that we have the right buying opportunity. And this is really key. But Lance, you missed the bottom in gold. I don't care. Because if I break out of the downtrend and I know for a fact that gold's going up and I've got momentum and I've got the technological basis that I'm going to make more money possibly than lose money, there's plenty of advance. The last time that gold broke out was back in 2000. You had a great run. What did you miss coming off the bottom? Not much. The philosophy of investing for me is very simple. I may not sell out at the top. I may not buy in at the bottom. But if I capture somewhere around those areas, I'm going to get about 80% of what's in between. That's more than enough. We'll be fine. Because I'm also going to miss the 80% on the other side I don't want at all. Interest rates. Back in 2013, Bill Gross came out, and CNBC's been on this for a while. He said, interest rates are going up. The bond bull market is over. Get out of bonds. Interest rates are going up. I wrote an article beginning in April of 2013. I've reiterated it several times. I said, not only is the bond bull market still very alive and well, it's where you want to be. Interest rates track one thing: economic growth. No matter how you break this down, this is, by the way, this is GDP. This is interest rates. Interest rates are a function of demand within the economy. Has two fronts. When you're going out and so in order for the economy to grow, you have to produce something first so you can get paid, so you have money to go out and buy stuff with, we're a consumption-based economy. If you're not working, you can't consume. So production comes first, consumption comes second. The issue is that interest rates are a function of demand within the economy. If interest rates go up, it's not necessarily a bad thing. What it means is that banks are able to charge more for a loan that I give to somebody to go build out their property, plant, or equipment. They're willing to pay more for that loan today because the demand that they have coming in from their consumers says that the spread between what I'm going to make on that building that new plant is going to outweigh the interest rate that I pay for the loan, which makes this a profitable investment. And that's why in the 60s and the 70s, interest rates were going up. They got a little out of hand at the later spree, but they were going up initially because economic growth was growing at 6%, then 7%, and then 8% annually. Interest rates were going up because the economy was going up. And you see that in this chart. But what happened since 1980? Economic growth has been declining, and as a function, I can't charge more for interest rates. And this is interest rates. So until you are able to generate stronger economic growth, which, by the way, you cannot, when you have 100+% of debt to GDP, the extraction of what you have in revenue coming in from taxes that's going out to pay for Social Security, welfare, other entitlements like the Affordable Care Act, and interest payments, when that eats up 75% of everything you're bringing in revenue, you cannot create economic growth. When you have household debt that exceeds 140% of debt to economic household net worth, you can't create more consumption. They can't lever up anymore to create more buying power. They're tapped out. So the ability for rates to go up, now look, rates are going to move up and down. Nothing goes straight down. You're going to get these little spurts in rates because of the Fed or whatever, but the long-term trend in rates are lower, and we will probably be somewhere closer to 1% by the end of this year than we will be closer to 3%, which is the current projection. This last line tells the true story. The last line I just put up there is what's called monetary velocity. Monetary velocity is the demand for money within the economy. It's how money's moving through the economy, who's demanding capital. Monetary velocity has been plunging since 2009. You cannot have increasing interest rates if you don't have an increase for demand of capital. Right now, businesses are only operating at the fringe of what is happening in terms of population growth. So in other words, what I mean by that is that we've got population growth that averages about 200,000 people a month. What's been job growth? About 200,000 people a month. Here's the interesting story. The government says employment's doing fantastic. We're doing great. But do you realize that the population has actually grown faster than the employment since 2009? We have more people in the population than we have people actually employed, which means that technically we have a negative growth rate in employment since 2009. But this shows you that because of that, companies are hiring. They're hiring waiters and bartenders and wait staff and these type of jobs to meet population growth, which I don't, but if I owned a restaurant and I have and y'all are all my customers, I know that I need a certain number of wait staff to wait on all of these individuals. If all of a sudden we add a whole new crop of individuals to the company, to the country that are now coming to my restaurant, I'm going to need 3 more waiters. So I hire 3 more waiters. I don't hire 10 expecting that to double. I'm only hiring 3 to meet the demand. And that's exactly what we've seen. And this is why bonds are still a long-term buy. In fact, in last week's newsletter and in this week's newsletter as well, I'm saying it's time to buy bonds. I still think rates could move up a little bit here. We could get to maybe 2, maybe 2.1% sometime this summer. It's very possible. But any tick up in rates from here is a further buying opportunity. Scaling into bonds makes a lot of sense right now. And if you buy bond funds, I really like Jeffrey Gundlach's bond fund, Double Line. The point here to all of this is that managing risk is far more important than worrying about what the market's doing. Making sure you keep your capital is far more important than worrying about what CNBC says is going on or what Jim Cramer's screaming about on television. If I'm wrong, if everything I've said is wrong and everything rights itself next week or next month and turns back up, I'll be the first guy writing the newsletter, time to increase exposure. Buy back in. It happens sometimes. Not very often, but it does happen. But that's the point of actually managing your investments. Sitting on them, hoping they're going to work out over time, is not really managing money. Hope has never been an investment strategy that's been successful long term. So I hope you found some benefit to some of this. I'll be sending you the slideshow once it's done, and we'll also have the video presentation available for you as well. But I really appreciate y'all coming out today, and we will be doing this again on maybe a quarterly basis as we go forward. And I encourage you to get by the website, realinvestmentadvice.com, send any questions that you have. You get home, say, hey, I got a question, I didn't understand this. I'm happy to help. So, but again, I want to apologize for the parking situation today, and I do appreciate y'all spending your time on a Saturday to come out and listen to all of this. So thank y'all very much.